Hello everyone. So yesterday the State Bank of Pakistan held the first Monetary Policy Committee meeting of 2025. As broadly expected, they cut rates by 1% or 100 basis points. And this was pretty much expected by the market. Now, just to give you a bit of background, the policy rate until June 24 was 22%. So that means they've cut rates by a total of 10% since June of 24. Now, against a backdrop of declining inflation, which reached in December down to 4.1%, so on the surface of it, a 12% rate still looks pretty high. If you recall, inflation was up at 38% about a year and a half ago. And this decline in inflation, this very strong trend towards disinflation, has prompted calls for single-digit policy rates. So on the surface of it, it seems as though the State Bank is acting in a very cautious manner. Now, the reason here is that firstly, they do expect inflation to pick up in subsequent months towards the end of this year, end of this fiscal year, in fact, which is in June. And the second reason is the fact that core inflation is still fairly high. You know, we had this headline CPI, which is the main indicator, down to 4% in December, and expected to be sub 3% in January. Now, the core indicator, which excludes very volatile food and energy prices, came in at 9.1% last month, and this is still fairly close to the current policy rate. Now, why is this important? Food and energy prices tend, firstly, not to be influenced as much by interest rate movements. So it tends to be very volatile. What really is impacted by interest rate movements are things like goods and services, where the interest rate tends to impact demand and supply conditions. So that, as I said, is still fairly high. So the State Bank looks at core very closely, the core inflation indicator. Okay, another factor is the external account. Now, we've had in the past several external account or balance of payments crises where we've had a surge in imports leading to a heavy pressure on the currency, and we saw, in the past few years, the currency moved from 104 to the dollar and now up to 280 to the dollar. In fact, about a year and a half ago, we saw a very sharp movement in the dollar rupee, where we had not just the official interbank rate, but the curb rate and the unofficial rate shooting up. And that's something the State Bank wants to avoid. So one way of keeping imports suppressed is to keep interest rates fairly high so that that demand for imports doesn't kick in. Okay, now another very important factor is the international outlook. Now, since the election of Donald Trump in the US, we've had a lot of volatility in global markets. One of the key factors is that how his policy is going to affect inflation in the US. We've had the 10-year US Treasury yield move up from around 4.20 before he was elected, all the way up to nearly 4.8%, and now down to 4.5%. And this is an indication of the concern that people feel that, firstly, if tariffs are increased, that would lead to inflation in the US. They're talking about tax cuts in the US, which tends to be inflationary. And so the inflation outlook in the US looks very different to what it did a couple of months ago. And why is that important for us? It's because the US inflation and interest rate outlook impacts the entire globe. Not just the US, but Europe, the Far East, China, and even in Pakistan. Because, for two reasons. One is that inflation in the US, because they're the biggest importer of goods in the world, accounting for 25% of global GDP. If inflation tends to push up in the US, that will in fact impact inflation across the world. The other thing is that as inflation picks up in the US, interest rates will pick up there as well or stay fairly elevated. And that would suck in capital from other countries into the US. And we've seen that already, where a lot of investment is taking place in the US. And so one thing that central banks around the world are going to be very cautious of are capital flows. So one way of attracting capital flows is to keep interest rates elevated in your domestic currency so that we don't see a big outflow of capital. Okay, so coming back to Pakistan, now there will be some disappointment from the business community and perhaps the equity market that there wasn't a deeper cut. The businesses obviously wanted a lower borrowing cost. The equity market would like lower yields. But really, given the challenges and the uncertainty, especially the global outlook, we feel that this is an appropriate policy mix. And one thing that needs to be borne in mind is that if we do see an uptick in inflation, the state bank might have to raise interest rates, and that's something they want to avoid. So they want to avoid cutting rates too fast and then having to reverse that and raise rates, because that will lead to a lot of uncertainty and a lot of concern in the market. So we feel this is an appropriate policy, and looks like going forward it will be, as I say, data dependent. So it'll be one step at a time. That's what we're looking at. Thanks for tuning in, and we'll keep you updated on any further developments.